The Wilson Center. My name's John Sewell. I'm a senior scholar here, and I know many of you, but I'm glad you're here for what's going to be a very interesting meeting, which is co-sponsored by the Wilson Center, particularly the PAGE program, and by New Rules for Global Finance, and with the Heinrich Böll Stiftung. I want to say just a word about the Wilson Center. It is the living memorial to President Wilson, set up by Daniel Patrick Moynihan and a group of distinguished people who were Wilson's great admirers. He was the only president who had a PhD, in this case in international relations. And although he was also one of the world's great racists, if you lived in Washington, D.C., and the monument is to not that aspect of it, but his concern with international affairs and the importance of American foreign policy. And that's why we're all here, and I have the distinguished honor of turning this over to Tom Palley, my fellow co-member of the board of the New Rules for Global Finance, chaired by Joe Marie Griesgraber on the other end of this table, and let him run this meeting. It is all on the record because you're being videotaped, and you can probably pick it up. It will be streamed sometime after the meeting is over. Tom?
Thank you, John, and thank you all for coming this afternoon. I want to begin again by thanking the Woodrow Wilson Center for co-sponsoring this event and making this lovely room available to us. I also want to thank the Heinrich Böll Foundation, who are also co-sponsors of the event, and they provided us with a small grant to pay for things, including our lunch. And then, of course, the third sponsor is the New Rules for Global Finance, of which I'm a board member. And our executive director is Joe Marie Griesgraber, who's sitting there at the left-hand side of this table. A quick word about what New Rules is and does. New Rules advocates for pro-poor, progressive change in the global economy, and particularly with regard to the international financial architecture and rules for financial markets, where, of course, poor folk tend not to have any representation at all. Today, we have four very distinguished speakers to discuss the issue of the economic crisis and the U.S. policy response. Just right, too little, or too much. Since we have a limited amount of time, I want to use it as fully as possible for hearing from the speakers and also having some Q&A afterwards. So I'm going to be very brief on the introduction. Please forgive me if I'm too brief. The first speaker is going to be Ron Blackwell, sitting to my far right here. Ron is the chief economist of the AFL-CIO. He has spent most of his professional life in the trade union movement, working with the textile and apparel unions before coming to the AFL-CIO, and of course that's a group of workers who really have felt the force of economic change and globalization over the past 30 years. The second speaker, sitting here to my immediate right, is Uri Dadush. Uri is the director of the International Economics Program at the Carnegie Endowment for International Peace, and before that, Uri had a very distinguished career at the World Bank. My third speaker, to my left here, is Michael Lind. Mike is the director of the Economic Growth Program at the New America Foundation, with which I have some association. And he's also the co-founder of the New America Foundation. People might not know that. I think Mike is really one of sort of a leading public intellectual figure talking about political economy in the United States and the global economy. They're written very widely and very accessibly on these issues. And actually, the curious thing is I almost met Mike 30 years ago at Yale. I was on my way out of the international relations program as I think Mike was coming in the following year. And then the fourth speaker is Prakash Lungani, who is an advisor to the IMF research department. He too has had a very distinguished career at the IMF, and I think was at the Federal Reserve for a while too. And again, we have a sort of an interesting connection. About 30 years ago, no, it's only 20 years ago. 20 years ago, I was writing a paper on measuring structural unemployment, and so was Prakash. Prakash's paper got published in a much more highly regarded journal, but I've always felt that my methodology is better, but I still haven't persuaded him of that. Well, of course, that's economics. So we're going to have 4 speakers, and we're just going to go straight consecutively. We'll save all the questions for the end. I'm asking speakers to have 12 minutes each, and I'll give you a 5-minute warning and then a 2-minute warning. And then after that, we'll do a full 50 minutes of Q&A, and I want to just reserve 2 minutes at the very end for some closing comments. Thanks very much. Ron, over to you.
Thank you, Tom, and thanks to New Rules and Joe Marie and John for hosting this event and for inviting me to participate in this very distinguished panel. It's obviously for me personally and for the American and the international labor movement a very important subject. To the question posed in the title of the session, which seems fairly easy to answer to me, with the unemployment rate at 9% at 2 years into the recovery, likely to rise before it continues to fall sustainably on my evaluation, it can hardly be said that we're doing too much or just right. The real question here in Washington, as those of you must recognize in this discussion, is too little of what? Too little tax cuts, too little fiscal stimulus, too little deregulation, to what and in what combination? I want to just present, and this is a adjusted slideshow. I was just intimidated by Prakash's excellent presentation to come to offer something. But what I want to do is establish a kind of factual predicate for the crisis we're still trying to emerge from. My own notes on my own interpretation and reason from there in evaluating what the U.S. policy has been. This is, could have been skipped. I'm borrowing 2 sets of data. This one is from Reinhart and Reinhart, sort of an evaluation of the current global crisis. It's a complex index that was constructed by Rogoff and Carmen to sort of describe the kind of crisis that we've been dealing with. And this is crises you may not be able to read. No, you can't read it, obviously. But this goes back to 1900. And don't worry about the colors of the lines, et cetera, but if you just focus on the pre-war period, and that is the period on the left, you can see that the volatility of the economy was extreme during that period. After the Second World War, after that long dip, it was fairly stable. This was generally described here in Washington as the Great Moderation. But this last crisis, toward the very far end, is enormous. It's completely out of all proportion of our lived experience in the United States and in much of the world. And it looks more like the pre-World War II period than it does like anything that has come since. That's the point I want to make here about this. The second thing is that the impact of this crisis on employment is very different than anything that's in my lived experience, and I'm a fairly old guy in the room. This is drawn from the website of Calculated Risk. It's a little funny because it's a photo of a shot, but it basically takes all of the post-war recessions in the United States and maps them against the bottom of the recession. The 2 points that I want to note about this one, however, is that all of the recessions in the post-war prior to the last 3 have a V-shaped. Even very serious recessions like the early 1980s or mid-1970s, which is one of the most serious ones. That's because these recessions were largely policy-induced recessions. They were prompted by a central bank reacting to inflation, raising interest rates. Sometimes the dollar went up as well. Activity slowed down, inflation abated, they took the foot off the brake, and interest rate sectors led the recovery out. It was very promptly recovered. Even the early 1980s, which I remember as an extremely, in the labor movement, extremely traumatic kind of experience, but still it was a very quick recovery. The last 3, which is the black line, which was the 1990, the brown line, which is the recovery from 2001 recession, and this most recent one, the red line, represent something very different. And this is not only are they much more prolonged, they were each called to various degrees a jobless recovery. Each one is getting more serious than the last. And I want to argue this is because they are not policy induced. They were produced by collapsing asset prices and acute credit crises. And in the most recent case, by a global financial crisis, a global credit crisis, and a global recession. Now, the Reinhardt's, Prakash's people at the IMF noticed that when they studied this in response to earlier crises, that recessions that are conjoined with either a credit crisis and or an asset deflation and or global tend to be more prolonged in their recovery. So what I want to argue is we're dealing with the effects of an economic crisis that is unique in post-World War II experience in magnitude and is similar in nature only to the recessions of the last two periods. And that requires a different kind of response than anything that we have known in the past. And this is the first point to make about the U.S. government response, because in contrast to what was said about it, what was done about it, timely targeted and temporary fiscal stimulus is completely inadequate to deal with this kind of crisis. Wow, okay. I hope others can skip over that. Skip over that. Only to point out here that this started as a bursting housing bubble. It is evolving. The housing bubble did trigger the credit crisis. The credit crisis did produce the recession, and the recession spread very rapidly globally through trade channels. But and the governments of the world were working pretty well together in 2009 to keep us from sliding into a Great Depression. But with the eruption of the sovereign debt crisis, particularly in Europe in 2009, this has really tied us into a knot. And we've got a political blockage right now in Europe and in the United States in dealing with the kind of unique challenge that we have in front of us. Now, I'm just going to list this. I'm just going to say this was not policy induced. This was an imminent crisis that resulted from fundamental imbalances. And here I'll only list them. This was the external account imbalance of the United States in particular, the imbalance between the financial sector and the real economy, the imbalance between workers and employers, which ruptured the productivity-wage relationship, which is driving inequality 30 years even before this crisis. And the relationship of inequality to the crisis is something that we might want to explore. So if this is a unique crisis, it needs a response that is more than simply loose monetary policy, taking the foot off the brake. It requires a more complex response by government. What I found heartening, both in a domestic policy and in his international strategy, was Obama's formula, iterative formula, which I borrow from Christy Romer, the first chairman of the Council of Economic Advisors, that argued that we have a complex task here. We have to rescue the economy. At that time, it was in complete freefall. And we have to recover from this recession. But we can't just do that. We have to address these fundamental imbalances that caused the crisis in the first place. If we don't, it'll be harder to recover, and we'll be more apt to fall back into it as a result. We've got to rebuild the U.S. economy, because if one of the imbalances, I want to argue, is our external account imbalances, that's due to the lack of the competitiveness of the U.S. economy that was borrowing 6% of our GDP even before the crisis took place. It means rebuilding our manufacturing capacity, our country's export infrastructure, our education of our workforce, et cetera. And finally, we've got to reform. And here you could look at the need to reform finance, which is a question, and we need to reform the world monetary system as well, and the process of global governance as well. Now, this is a long way to get to this point, but I simply want to go through this and say, have we rescued the banks? I mean, they were stabilized. They're out of critical condition, but they're hardly healthy. They're awash in money, but there's no lending going on, and they're still making the most of their money in trading. That is not why we want these companies. And they're stronger now, more powerful economically and politically than they were before the crisis. So this has not been fixed, and that's the limitations of reform. I'll get there. Rebalance. Obviously, our trade deficit improved because the recession dropped our level of economic activity. That dropped our imports, and it looks better, cut in half or so. But we really haven't changed anything on that front. And as our economy does recover, we will rediscover these imbalances. And so I think the innovation that I'm very much approving of shifting the center of negotiation internationally to the G20 is exactly the right thing to do. The framework on more balanced growth is the right thing. The mutual assessment process, the important role that the IMF has been playing in this, in supporting this process is very essential. But we don't have the results yet on rebalancing. And on the rebalancing, remember, it's both the macroeconomic side of things, it's the financial side of things, and it's the social side of things. And by that I mean rebalancing the bargaining power that working people have to deal with their employers so that they can get their share of increasing productivity in their wage. And reform, we've done very little of that. And partly that's because our elected leaders and our policymakers, and including the people in administration, though this was on their agenda, high on their agenda, simply haven't delivered the policies. So I think that my evaluation, summary evaluation of the U.S. reaction, both domestically and internationally, is that the Obama administration came in with exactly the right framework for thinking about this recession, its unique character, and the kind of complex policies that are going to make it possible for us to recover and to rebuild the economy. They simply haven't delivered the policies behind it. And there's a discussion, obviously, about whether they didn't do that because they weren't allowed to politically or because they were conflicted, lack of imagination, courage, whatever. We can talk about that in discussion. But basically, that's the notion. They had the framework right. They didn't have the policies to follow the framework. And finally, I will say, my deep conviction is the right strategy could proceed directly off of the last State of the Union message, winning the future. If we don't need another stimulus program, what we need is a sustained public investment program to educate our workforce of the future, to train a workforce of the future, to rebuild the infrastructure of this country, both traditional and the forward-leaning infrastructure we will need to pull our weight in the world. And it needs to be sustained. And with millions of unemployed construction workers, millions of unemployed manufacturing workers, a $2.2 trillion deficit in basic infrastructure, and an ability to borrow money on international capital markets of now less than 3%. There is no excuse for not putting these people to work, having jobs right now, and rebuilding the basis for a competitive, sustainable recovery, and that it will be more equitable when we get tight labor markets and rebuilding institutions of our labor markets. Thank you.
Thank you.
That was good. Okay. Oh, you want to shift it to?
Why don't you swap seats, just in case wiggling the wires sometimes.
So let's see if I can find this.
It's on the desktop.
Yes, thank you. Thank you very much, Tom, for the invitation, and very much appreciate this opportunity to give you a little bit the international perspective on the U.S. response to the crisis. I come at this not as a specialist on the U.S. economy, but as somebody who looks very regularly at international economic trends. And so I try to apply a little bit that viewpoint on what's happening here. And I have three main points. When you compare what's happening to the U.S. During the crisis and the rest of the world, you see that the U.S. policy response was the biggest in quantitative terms. And also that the output decline was relatively shallow. So this was a very bad recession in the United States compared to history, but it was not a very bad recession in terms of output decline compared to other countries, despite the fact that the United States was at the epicenter of the crisis. So in a sense, that's good news. The bad news, as Ron has already flagged extremely well, is that we have a huge surge in unemployment. I'm not going to give you an explanation of why the surge in unemployment, and I look forward to the discussion and to the other presentations. But it is a puzzle, just how big the surge in unemployment has been, especially compared to other countries and compared to the decline in output in this country, which was relatively shallow. The second, of course, is we have a looming fiscal crisis in this country, and relatively little has been done about it compared to other countries. And the third is that emerging markets, China, etc., helped quite a bit up until now, but they can't help much more. They're overheating. So these are three big residual problems. And so my overall assessment from this international perspective is United States response to the crisis probably deserves an A if you compare to what happened during the Great Depression. However, if you compare it to what's happened in other countries and how they responded, the grade is less flattering. I don't know, maybe it's a B, maybe it's a gentleman's C. Or a lady C in this day and age. But the point is that there are a lot of issues that emerge when you do this international comparison. So really, these are the main points I want to make. And if I'm allowed in my 12 minutes, I will show you some charts. US had the largest fiscal stimulus of any country in the OECD, except Korea. That's the red arrow is the United States. And US response was about evenly balanced between increased spending and reduced taxes. So this was a very large stimulus package in international perspective. Of course, this is where the crisis originated. And the cut in US interest rates was just as draconian as anywhere else. So monetary policy response was very aggressive, and that includes the expansion of the central bank balance sheet, which was bigger than any country up to the end of 2010, except for the United Kingdom. So the quantitative expansion, if you like, of the money supply was very large, and this doesn't include the latest QE2 package. So if you put in the QE2 package, you have to say that the US policy response was huge, including compared to other countries in quantitative terms. The United States was also helped by the fact that it remained a safe haven during the crisis, which is one of the great historical ironies, that here was the country where the crisis originated to a very large extent, and yet the dollar exchange rate appreciated through the crisis. This, in a sense, helped the counter-cyclical response of policy, because people didn't lose confidence in the United States. Money came in. And then when things stabilized in the world, the exchange rate devalued again. So the United States clearly benefited from being a safe haven. This chart shows you that the decline from peak to trough in US GDP was actually relatively shallow compared to the other G7 countries. It was in line with France and Canada, but it was a smaller decline than the other G7, Japan, Italy, Germany, and the United Kingdom. And the recovery from the trough has also been pretty good. United States GDP is now above its previous peak by a small margin. Only Canada exceeds that performance. Germany is still below, is at about its previous peak. And Japan, Italy, and the United Kingdom are well below. So again, despite the fact that the crisis occurred here, helped by the safe haven effect, helped by the massive fiscal and monetary response, but also helped by structural features of the U.S. economy, the fact the U.S. economy has more services, is less cyclical, and the fact that the U.S. economy relies less on commercial banks than do the European and Japanese economies. All this helped moderate the output decline. But you have this enormous question about unemployment, this surge in unemployment, which is quite disproportionate to what happened in the other countries, and also what happened to output. And Ron has offered some explanation. I know the IMF has some views, and I look forward to hearing them. But clearly the fact that unemployment has not only surged, but has stayed so high, is staying so high. And remember that this is a country that has relatively weak social safety nets compared to any of the other advanced countries, makes this very painful. And furthermore, the rise in unemployment is occurring against the background of very relatively low increases in median household income over the last 20 years, although they're not as bad as they're often depicted to be compared to other countries, because median household income in the United States has increased a little bit faster than Germany and Japan over the last 20 years, which have seen very little increase, right? But much less than the United Kingdom or Spain, turns out not to be sustainable, and less than the OECD average by a significant margin. So that's a big, big issue that remains, and of course it's a big policy question. The second is directly related to the size of the fiscal response and fiscal adjustment, is that the United States has more to do than any other country today in order to stabilize its long-term debt. These are OECD calculations. So the fiscal adjustment needed to stabilize the long-term debt in 2010, if it had been done in 2010, according to OECD, would have been about 11%. Okay, only Japan compares, really. Ireland, of course, which again is a country in terrible trouble. But most other countries have a much smaller effort to make. So Germany and Belgium and Korea are at the other extreme, where the needed adjustment to stabilize the long-term government debt is only about 1 or 2% of GDP. Furthermore, today, all countries have done more towards this target than the United States has in terms of the measures that have been agreed. And the one exception is Japan. So Japan and the United States today stand alone as countries that have a huge fiscal issue. I'm not even talking now about the long-term problems of rising Medicare. I'm talking about stabilizing the government debt to GDP ratio in the course of the next 2 to 3 years. United States and Japan stand alone as countries that have yet to undertake the necessary measures. And finally, can we rely on emerging markets? Well, we did. Emerging markets really helped in the course of 2009, but we now have a lot of emerging markets that are either in red or yellow. Red are emerging markets that are already way overheating. Yellow are emerging markets that are on their way to overheating, with strong, significant overheating pressures they cannot do much more. That includes Mexico and China. And only a small part of the emerging markets, such as Russia, that could do a little bit more. But these are, you know, when you add it up, all this is about the size of the U.S. economy. So don't rely on a big demand stimulus coming from the rest of the world. So in conclusion, it's difficult for me to say, looking at it from an international perspective, that the United States didn't spend enough. Now, I know some people think that, okay? But it's, when I compare it with other countries, and I look at the fiscal problems that we have here, very difficult for me to say there wasn't enough wallet here. But it is very easy to argue that we could be more targeted in the way that we intervene. And here, I would argue that if you had more automaticity in the response, mechanisms whereby the social safety nets were stronger, or the aid to states, which, because of the way that the constitutions are set up, behave pro-cyclically. If there was more automaticity there to the aid, well, that would reduce all the politics, but it would also be faster. If the automaticity was done right, it would be more targeted, and the various economic actors would be reassured that that safety net was there, so they wouldn't react quite so draconianly in the event of a downturn. So that's one thing that I think can be done better for the longer term. The other is we need a medium-term fiscal framework. We need some agreement on how we are going to bring down this deficit. I'm not saying anything new here. I am very aware that this is a big political issue, but we are asked to judge the policy response as technocrats, and I have to say, you know, that's missing, and that's going to affect confidence in a major way going forward. We need to understand better why the unemployment increase in the United States was so large relative to its GDP, et cetera, and see whether there are some reforms that can be done in that direction. And finally, I have to confess a bias that I would like to see less reliance on monetary policy. If the stimulus, the fiscal stimulus, was more targeted, more intelligent, we wouldn't have to have interest rates so low for so long and such a huge expansion in the money supply. The reason I don't like that is because I have been, for too many years, seeing, you know, long periods of low interest rates build up all sorts of crazy behavior that you never really understand until the crisis hits. You know, the carry trades. This is what emerging markets are terribly worried about at the moment. But I think we should be worried about it in the United States and in Europe. I'm sure there's a lot of speculative behavior going on that will be uncovered when the interest rates start rising again. Thank you.
Thank you very much.
Escape. Get out.
Which is the one for the, this is down here. The view.
Oh, right here.
There? Yeah. Okay. See, so I need to. Yeah, I'm going to speak about entirely the domestic aspects of this and raise a topic that hasn't been brought up so far, which is that the United States is not a unitary state. It's a federal system. And you have somewhat disconnected policies going on at the federal and at the state levels, and I'm going to dwell on this in particular. To begin with, to give credit where credit's due, you know, I think most people will agree that there was considerable success in averting the worst consequences. Austerity at the state level and the local level was offsetting otherwise, fairly intelligent federal stimulus programs. And as we see here, the state shortfalls are declining, but as you know from the news and from battles over state pensions and so on, this is continuing to be a major problem. You have government income support will be going down along with other stimulus spending, including spending for the states. So let's look at the labor market picture as we emerge from the crisis. There's an enormous class difference. And in addition to talking about the federal and the state level, about America not being a unitary state, it's also not a unitary society. So if you look at Americans with bachelor's degree or higher, unemployment is extremely low compared to those with a less than a high school diploma or high school graduates. And just, the average unemployment rate is somewhat misleading unless you break it down this way. These are the largest occupations at the moment, with the exception of registered nurses. 9 out of the top 10 pay far less than the U.S. mean wage. And if you then go on to look at the rate of growth and not just the absolute numbers, you see an ongoing pattern of polarization where the fastest growth is in low-skill jobs. The second fastest growth is in high-skill jobs, for example, business and professional services. And you see a lot of medium-skill jobs, particularly those associated with the skilled trades and manufacturing in the past, disappearing fairly rapidly. And at the same time, you see long-term growth in the contingent workforce, which is 30% now. Who knows? In a decade or two, it could be 40% or 50%. People disagree about what to do with this, whether this is a bad thing or whether this is something that you should accommodate in a more flexible labor market through various reforms. So I want to suggest that we change the frame in which we think about the crisis and policies. The initial frame was Larry Summers' statement, which has been quoted earlier. You have to have a timely, targeted, and temporary stimulus. And at the New America Foundation, we critiqued this from the beginning because we thought this is not a typical business cycle recession in which you just inject a little stimulant, and then you get back. That is, it's the end of a 20 or 30-year period, and it's just that period is not coming back ever. And wherever you stand on the structural unemployment debate, which has tended to become polarized between left and right like everything else, it's clear that a lot of the jobs from the bubble economy, in construction, for example, are not coming back either. So I think we need to think about this not in terms of a policy that can be done successfully with the existing government structure, but of an opportunity for structural reform, both to help out now, but also to avert or to cushion and ameliorate the damage in future crises. And Yuri Dadush used the term automaticity, and that's exactly what I think we need. I call it the Reagan-Nixon plan. It's probably far too liberal for Washington in the present climate. Ronald Reagan in 1983 proposed completely nationalizing Medicaid. The Medicaid program, as many as you may know, along with unemployment insurance, is divided between the federal government and the states. Well, why is it divided that way? It makes no sense because the federal government can borrow much more easily in crises than the state governments. Well, we have these hybrid federal-state governments because the Democratic Party at the time was, in the 1930s, was dominated by its southern segregationist wing. And I won't go into the whole history here, but in order to keep a pool of cheap labor, white as well as black in the South, they wanted to minimize the bargaining power of workers in their region, and this was the price. And so, fortunately, Social Security and Medicare were created as purely federal programs in the first place. But so if you nationalized or federalized, if you want to use that term, Medicaid and unemployment insurance, and these were purely federal social insurance programs, they would immediately have an enormous effect as automatic stabilizers in crises like this in the future. And they would have had a much greater effect. You wouldn't have state legislatures ever again trying to come up with the money for their share of the Medicaid program because it would all be federal. And they could concentrate on other things, including infrastructure and schools and so on. Just on this note, if you look at the components of the American Recovery and Reinvestment Act, they were divided between, infrastructure got a lot of play, the earmark infrastructure. But there were also two other elements. There were the tax cuts, which most people agree were fairly ineffective. And the other group consisted of two programs. One was federal government subsidies to state Medicaid to help the states out with their state part of Medicaid. The other was a fiscal stabilization administered by the Department of Education, which largely went to public schools. Those two things, the Medicaid aid by the federal government and the general revenue sharing, helping with the public schools, those are the two elements of the Reagan-Nixon plan. The first is the proposal to federalize Medicaid permanently. The second is revenue sharing, which was one of the most enlightened programs in the history of the United States. It was supported by Lyndon Johnson and Richard Nixon, by liberals and conservatives in the 1970s. It died during the tax reforms of the 1980s, not because it was unpopular. If you took polls, everybody liked it, but because it lacked concentrated political support by energized minorities. So what happened was you had libertarians on the right who just hated it. You also had liberals who wanted targeted programs instead of general revenue sharing. If you had general revenue sharing, that would be another enormous automatic cushion for states, so you wouldn't have this kind of undertow in future crises like that. So I think the phrase to think about in terms of this crisis, and the reason why I titled this From Recovery to Reform, is that we need to change the structural aspects of the federal state system so that there are all sorts of other problems we face, but this is one where there's a fairly straightforward solution. It's been supported by Republicans as well as Democrats in the past, and that's a combination of completely federalizing existing hybrid federal state social insurance and some degree of general or block grant federal revenue sharing. And that's it. Thank you.
Just hit the escape button.
Okay. There we go. Kill this.
Okay. Thanks very much to the organizers and to Tom for inviting me to speak here. I'm going to repeat a fair bit of what Ron and Yuri said, so I'll try to be quick. I'm just going to talk about two things. One is the impact of the crisis, which Ron described, and then the policy response, where there's quite a bit of overlap with what Yuri said. So as you've heard many times now, and surely know already, that the U.S. was the epicenter of the crisis, particularly in the unemployment impact of the crisis, accounting for half of the increase in unemployed people over the course of the crisis. The major reason for the crisis, for the unemployment increase, was obviously the drop in demand. Christy Romer, as was described once in the New York Times as saying that she used to be in these meetings when she was in the Obama administration, where people would puzzle about why unemployment was going up and what's going on. And she says that she would sit through these meetings and wish that she had the courage to say, it's aggregate demand, stupid. When demand falls, firms lay off workers. That's what happens. So this shows you that there is indeed a relationship between the country's drop in GDP or demand in the short run and what happened to unemployment. Not just short-run unemployment, but even, as shown in this chart, long-run unemployment. Now, as Yuri correctly pointed out, I mean, there is an association, but it's not a perfect one, as you can see. The United States, you can see in the chart, stands out as a country that experienced more unemployment during the Great Recession than could be explained by the drop in its GDP. But still, just realizing that the major reason why we had this big surge in unemployment was because demand dropped takes you a long way to explaining the impact of the crisis on ordinary people. Okay. Now, to sort of start to characterize the policy response, I very much agree with Yuri that the Fed, particularly the Fed and the administration in general, gets an A if you compare the response compared to what happened during the Great Depression. There was a serious there was some chance that we would end up in a Great Depression, and we avoided that. So in that sense, policymakers did well. As he described, interest rates were cut sort of across the globe, and done so in a sort of coordinated fashion. In addition, as Yuri showed in his charts, there was expansion of the balance sheet, 2 rounds of quantitative easing by the Fed. So I think all this means that the Fed sort of did its job and avoided basically the mistakes that it had made during the Great Depression. The fiscal response was also decent, and particularly so in its early stages. The group of 20, the G20 countries, early on met and had a coordinated fiscal stimulus. And what you're seeing here is a chart that tells you sort of where the buildup in debt that we are experiencing as a result of having had to provide that stimulus, where it's coming from. A lot of it is coming from that blue part, the revenue loss. Again, this is just saying, this is the equivalent of its aggregate demand, stupid. I mean, why do we have a buildup of the debt? It's because we lost tax revenue during the crisis. That's what happens during at the ends of recessions, is governments have lost tax revenue, and unless they cut their spending during the recession, which would be silly, we are going to end up with the debt buildup. So a lot of the buildup in the debt just comes from the fact that we lived through a very massive recession. But you can see that we also did more than that, where we provided a fiscal stimulus. That's the red part of that pie. We bailed out our banks. That's the green part of it. And there were other factors as well. Okay. So monetary and fiscal policy sort of did the right thing, in my view, and fiscal policy certainly initially did much better than it may have done since. Okay. Now, with hindsight, we might have provided a more robust monetary and fiscal policy response, even more than what we did, and that might have helped some of the cyclical unemployment from becoming entrenched and becoming more sort of long-term in nature. Okay. Oops, sorry. So in hindsight, I think what I would go along with is sort of along the lines of both all 3 previous speakers, that maybe in addition to monetary policy, our fiscal and credit policies perhaps ought to have been much more targeted, and targeted, say, at particular sectors like the construction sector, targeted at trying to clear the log jams in the housing market, and also, as previous speakers said, tried to address some of the infrastructure gaps that would have put us in good standing in years to come. So in conclusion, I think that policymakers did well to avoid the Great Depression. I think that was a great achievement. We should not lose sight of that. And with hindsight, things could have been integrated better. As I said, we ought to and still are behind the curve on housing market policies, where the impact of the programs that have been announced to tackle foreclosures has been well below expectations. You read reports of program after program where X millions of dollars or billions of dollars have to be disbursed, and the actual take-up is in the thousands or the millions. You have programs where the targets are meant to help people in the millions, and then they say 5,000 people have so far applied for the programs, and then there doesn't seem to be a follow-up to say, well, why isn't anybody taking up these programs, or should we need to modify them? So much more needs to be done on housing market policies. On labor market policies, I think we're approaching the point where we correctly extended UI benefits to help the unemployed, but we have to think about how long we keep doing that. We ought to be thinking much more seriously about hiring subsidies than we have. Again, Christy Romer describes that this was mentioned, this was discussed while she was in the Obama administration. Some programs were put forward, but nothing really particularly creative or radical, given the nature of the unemployment problem that we are still facing. On monetary and fiscal policy, to conclude, I think monetary policy, as the Fed has announced, will remain easy through the end of the year. I think that's right. It will remain supportive of recovery. They are thinking about what an exit strategy should be as the economy recovers. That's the right stance as well. On fiscal policy, the IMF has sort of long recommended now, well, long meaning in DC time for the last couple of years. We've recommended during at the onset of the Great Recessions, we were one of the first agencies to call for a fiscal stimulus in the US and a global fiscal stimulus. Our stance now is that countries, including the US, should be putting forward credible plans for fiscal consolidation, but there is no need to have a harsh fiscal adjustment this year. So in terms of a slogan, my boss has in the past said we need a fiscal tightening in the future, but not a fiscal noose today, and that's our stance at the moment. So let me conclude on that note. Thank you very much.
Thank you. Well, thank you to the speakers for great presentations and on time. My apologies if I just sticking paper in there. It's not my character, but it seems to have worked. I'd like to throw the floor open to people now, and the procedure will be if you could announce your name, some sort of identification of who you are. Jamie, is there a mic or anything like that? Yeah, there's going to be a mic coming around, and I'm going to take questions in clusters of 4. And please, this is really an open discussion. I'd love to see some political thought interjected into the conversation as well, and we'll take it from there. So, one there. Can anyone else who wants to speak raise their hand? Number 2, 3, and 4. Okay.
Hi. Thanks for the comments. My name's Ken Paris. I'm an economist with the Communications Workers of America. I'd like to focus on a few things. One is, last speaker spoke about demand as being a key factor in unemployment. Obviously, if you don't have a demand, you won't invest, you won't provide jobs. But what we're seeing in the U.S. economy is that consumption is basically flat, increasing just a little. Business investment isn't great. The net exports are high and a drag, which leaves one component left for creating demand and increasing it, and that's government spending. So I'd like to throw out the issue of how can this economy grow unless there's a big increase in government spending, even now, so that there will be increased demands. And part of that is also related to what Ron was saying, not just spending, but public expenditures as investments in education, infrastructure. There's a lot of demands out there, needs that we can meet. So that comes, not on one level, it's an economic question. On the other level, it's a political question, because the policies of cutting the federal deficit spending right now is really bad in terms of the economy. So I'd like you to focus on both. Thank you.
Over here.
Thank you. Larry Ball from Johns Hopkins University. Very interesting presentations, all of them. This is sparked by Ron Blackwell's remarks, but anybody's feedback. Partly a nitpicky criticism and partly a constructive question. The former being about the fundamental imbalance between labor and employers. labor share of income before the crisis has been very steady for decades. No, that's not true, or no, that's not. Well, you can. All right. Well, anyway, according to the graph in the textbook I use, it looks pretty flat. And the income inequality might be from high-skilled workers versus low-skilled. No. Okay. All right. Well, so I perhaps been misinformed, and that was, you could explain why. All right. But the question is, again, maybe based on my flawed figures, one thing that one of the number of things in which this recession is different, which hasn't gotten that much play, is that labor share of income has fallen significantly. It's usually counter-cyclical, or profit share is pro-cyclical. And the early '80s recession was a peak for labor share. So I don't know whether somehow this recession has allowed employers to beat down labor unions more than past recessions, or what's going on. So that's a question. Thanks.
Yes, I'm Per Korowski, also from New Rules. Over the last 20 years, the fundamental pillar of all our bank regulations has been something that's called capital requirements that are higher when the risks are perceived as higher, and lower when the risks of default are perceived as lower. And that is great, sounds very logical. But that is exactly what the market also does when it charges the interest. When it perceives the risk as being higher, it charges higher interest rates. When it perceives they're lower, it charges lower interest rate. So there has been built upon a doubling of the risk aversion in the system that has taken off completely the whole dynamism of the small business and entrepreneurs who are being really locked out from the access to the bank credit. So in my mind, and on the part of the financial sector policy, one of the most immediate steps that could be taken is to reduce in the banking system the capital requirements for those small business and entrepreneurs who, by the way, have never ever created a bank crisis in mankind's history.
I'm Jo Marie Griesgraber with New Rules for Global Finance, and I'd like to thank you all for coming. And my question relates to the loss of income on the part of governments. And I know raising taxes may not be the thing to do, but how about recouping some taxes from those corporations that don't pay? And this is something that there's a coalition forming to do just that. And I'm wondering if this is factored into any of the thinking of your institutions and how it could be pitched politically.
Can we just run down, answer, if you want to answer all four, go for it. If you have whatever you want to, free range of responses here.
Well, I can start only because I'm going to be very brief. I think I'm the only one on the panel who can be fired for speaking the truth. So I think, I think this is going to restrict me greatly.
Plea for sympathy.
Let me take Larry Ball's question. I mean, I have the same figure. I use the same textbooks he does, and so I have the same view that the labor share has been sort of flat over a long period of time. I think where I do feel what some of the work we've done at the IMF in the last few years has looked at the inequality, which certainly increased tremendously in the U.S. over the past couple of decades, and as you said, during the Great Recession as well. So that's something that I think I agree with Ron is an issue that certainly was not on the IMF's radar, but is very much so now. And some of the work we've done is to try to understand the links between inequality, leverage, and crises. And setting up these models gives you the ability to then think about what kind of policy options would keep crises from happening again. And one of the predictions from that model is that restoring sort of the bargaining power of labor, restoring labor rights is one of the things that would keep this kind of cycle from happening again, as it did during the Great Depression and perhaps during the Great Recession as well. Let me stop at that, I think.
Well, I'll touch on two of these issues, beginning with the last question about the corporate taxes. I think that if the goal is to rebalance the U.S. and the global economies, part of that means some degree of policies. I know this is controversial, but for onshoring a certain amount of high value added production. that has gone abroad because of foreign mercantilist national policies, currency manipulation, things like that. So you just need, there's a trade-off in terms of the taxes. If you look at the corporate income tax, if you break it down by sector, the financial sector and various other service sectors pay fairly low. It actually hits manufacturing. It's very difficult for them to escape it. So that would just be, I don't have an answer. I'm just raising that concern that you not think about this totally as a revenue question, but also all industries are going to claim they'll disappear if you tax them. In a global economy, some of them may actually disappear from your territory. So that's just a factor to bear in mind. The earlier point about demand can only come from the government, I think that's true in the short term if you're thinking of recovery, but if you think beyond recovery to reform, then I think you need to, and I'm sure, I assume the speaker would agree, you have to think about distribution as well as redistribution. One of the problems arguably with the American economy in terms of demand is that as increasing amount of the gains from economic growth go to high-income people, and this happened in the 19-teens and 20s too, rich people spend less on consumption, and they spend more on savings, but also on speculation, trying to drive up the returns from their wealth. And so you're going to have fewer mass production, mass consumer services spending, and much more gambling in gold or oil or Picasso paintings or Miami real estate or whatever. After World War II and the New Deal, the U.S. managed through strong unions, partly it was because it was a closed economy, managed to have more of the gains from growth go to the working class and the middle class. I think absent that, I'm skeptical, I have to say, about certain proposals for permanent high levels of redistribution as an alternative to sharing the gains of growth more just in the paycheck, in pre-tax earnings. Because for one thing, the United States is a deeply anti-statist society. And also because diverse societies, at least this one, racially and ethnically diverse societies, tend to have more distributional conflict over after-tax redistribution than others. So I would agree, in short, that you can have more government demand in the short run, but in the long run, you want to build up demand at the bottom through a more equal sharing of the wealth.
Yeah, there's obviously a technical issue on wages and productivity growth and wage shares. We can deal with offsite. It's an empirical question. But my interpretation of the data is that wage share has been declining in the United States since the mid-1970s because of stagnating wages in the face of continuing rising productivity. And that wage shares are now falling faster since 1990. They're falling in a spreading array of countries. Most of the OECD countries, wage shares are falling, and for the same reason, a loss of bargaining power of workers and their unions. They're falling faster in Europe than they are in the United States, and faster in Japan than they are in Europe. And the only reason the U.S. stands out in relative good standard is that stock options of CEOs and baseball players are part of wages, which is of no satisfaction to the median working family, by the way. So that's why I'm saying there's a social imbalance here, which is not really dealt with either in our policies or in the institutions of global governance, which I hope we'll be able to get into later. I happen to be personally skeptical about the role of inequality, as serious as it is and important to working people as it is, as a first-order cause of the crisis. But it certainly explains, although Thomas disagrees with us, I think, but it certainly explains why the impact of this crisis has been as serious as it is. I would only point out that this problem, which Prakash mentioned, and Yuri did too, is the most serious impact is in the United States. And I see John Schmidt in the room, and he maybe have some explanation about why this is the case. But it's not unique to the United States. The recession opened up a 30 million hole in the global labor market. It raised global unemployment to 205 million people. It's the highest number in history that's ever been recorded. And this is 2 years into recovery, and even with rapid growth in China and Brazil and India and other places. And the IMF tells us that the global labor force is going to grow by 450 million jobs, needs to grow that fast to absorb new entrants into the labor force over the next decade. This economy is simply not growing fast enough to get that done. And so we're starved for jobs, and it's hard for me to see any policy being satisfied with policies, even if relative to other countries it worked, and it's bigger we ever had it. Relative to the problem of putting people to work, it's not working. Ben Bernanke says a recovery without jobs is not a recovery. That is certainly my point of view. And we should have rising incomes, and those rising incomes should be broadly shared. And we should have government revenue that's adequate to be able to meet our needs, collective needs, both domestically and internationally. And currently we don't. And so we need more robust policies and more ably coordinated global policies in order to move this economy forward, make the growth more job intensive, and help rebuild the balance pre-tax between working people and their employers all over the world in order to be able to share that very broadly.
Uri, over to you.
Thank you. From my vantage point, again, looking at this internationally, I do think that there's a big income distribution issue in the United States, disequalizing tendency over the last 20 years, 30 years in this country is really very, very marked in the data that is available to us. Now I know some people challenge the data, but I've tried to, within my time constraints, to look at this, and my sense is that the disequalizing trend is very real and very pronounced in this country. Also evident is that there is an issue of incidence of taxes. I agree. I mean, I think I don't understand why big corporations are not paying taxes in this country. And again, the incidence of taxation against income across income groups is quite skewed compared to many of the European economies or Japan, for example. I am no longer fireable because I speak the truth. I used to be. I have to say to you that sometimes when I see the political debate here, I feel like you're in the middle of a class struggle in the United States. I know it's a little bit out-fashioned. The Berlin Wall came down a long time ago, but it kind of feels like a class struggle. So I'm kind of reminded of my youth in Italy in the 70s with the Red Brigades. Now, you don't have the Red Brigades here.
We might.
But it's that kind of dialogue that the dialogue of the deaf. I think it is related to this disequalizing tendencies, and it contributes greatly to the lack of confidence in the system. And in the end, it will affect investment because people don't know where it's all going. They know it's not sustainable, but they don't know where it's going. We haven't really talked about it, and it's going beyond it, but I take the view that this country is actually extraordinarily competitive, believe it or not, even today. And every indicator that I can look at that from a business perspective looks to me like this is a very competitive economy. It's the most productive economy in the world. It has enormous rate of innovation. It's extraordinarily flexible, too flexible, perhaps. I agree, maybe too flexible. So that's not the issue. The issue is something else, and some of it also is that the resource allocation in the economy is very strange when you compare it internationally. You got 15, 16% of your GDP in healthcare spending, but I am French. I have a higher life expectancy than you do. And my economy spends half as much, roughly. A little, maybe. So there's that. You also, by the way, spend, I think, 5% on defense. And I mean, I'm not even a U.S. citizen, so I'm not going to tell you, how much to spend on defense. But it's strange that you spend 5% on defense, and the other countries, Europeans, etc., are spending what, 2%, something like that. So that costs. You put a lot in defense. You put twice as much as other countries in healthcare, etc. And then you have these. Some people don't pay taxes, big companies don't pay taxes. In the end, somebody's going to carry that burden.
Just quickly before we take another round of questions, I would just like to kibitz and add in on this wage share issue, because I think it's very important that people leave the seminar with an understanding of it. My understanding of it is that Larry is right that the formal wage share, this is a very important point, the formal wage share was fairly constant till about 2000. And in this last decade and in this recession, it has gone down. But you have to dig into the wage share, and this is where the work of Piketty and Seiss come in. What was happening in that wage share was a tremendous growth of inequality, with, as Ron referred to, stock options, they're part of labor income, formally. Baseball players, part of labor income. So all these guys on Wall Street, they get paid part of labor income. So this was pulling the thing apart. So when you look at, so that's why this wage share number is a bit misleading. I hope when you write a new textbook or you talk to textbook writers that people will begin to uncover this, because what was actually happening to wages was a different picture. They were collapsing. If you were to look at the share of income that went to non-supervisory workers, this was collapsing. And that non-supervisory workers are 80% of total employment. This is a very important point. Journalists don't get it. If there are any journalists in the room, I think it's worthwhile. Economists don't get it. That's why the textbooks are kind of misleading on it. I hope this clarifies it a bit. Let's take another round of questions. 1, I'm going to go right to the very back. 2, 3, 4. And we'll come, I'm sure you guys, your first 2 next round. Mark, can you just wait for the microphone to arrive?
Mark Harrison with the United Methodist Church office. I just had someone to explain certain things to me. First, we said at one point all the countries agreed that we needed a stimulus. Now all the countries just met. Now they say we need deficit reduction. Is that right? 2, now, Ron, you talk about public investment. Democrats don't want to spend more money on public investment because they're afraid of the deficit. All right, now I would like for persons who look at the United States, since you mentioned Ronald Reagan, and Yuri, I'd like to hear you answer this question. The Republican Party, why has it become so dogmatic on it when it comes to economic policy? It didn't used to, at least at some point, it wasn't like that. If you look at the French, is that considered a conservative party? You have the Conservative Party in rule up in Canada, and now they are much stronger when it comes to putting regulations on their financial institutions. And this conservative in this country believes that we shouldn't do anything, no regulation whatsoever. So why this dogmatism in economic policy by the Republicans? Why was so crazy, so strong, and Merkel so strong on putting restraints on their banking institutions, and the Republican Party here saying we shouldn't do anything?
In the back, are you ready?
Yes.
I'm Tony Wickrant. I'm just a humble itinerant bookseller, a simple man. And I kind of believe in that good old religion. So what I think is, where there is no vision, the people perish. And what I would have liked to have heard was some consideration of what type of economy do we want to build for the future. I think a good case can be made that the world financial system for the past half century has not really been based on the US dollar, but on a barrel of oil. We've had, for 40 years now, strong bipartisan consensus in the United States that we have to achieve energy independence. And we're more dependent on foreign energy sources today than we've ever been. And so the whole paradigm that the market is a better allocator of resources than the government has been proven demonstrably false. So if we rescue the economy, and I'm not convinced that we have, we still face the problems of peak oil and climate change. We have a good idea of where we need to go. Wind power, solar power, urban rail transit, high-speed rail, and so forth. The International Energy Agency's 2008 report estimated that the world needs $45 trillion in infrastructure investment to be able to meet the problems of energy. Earlier this year, the Urban Land Institute estimated that the world needs 50 trillion, we're talking trillions, not billions, in funding for new infrastructure over the coming decades. So we face today the same conditions we did after World War II that created the golden age of capitalism. We have huge pent-up demand for new technologies. We can create another golden age of capitalism if we do this right. The problem, of course, that we have is that we have entrenched economic and financial actors that are unsure which technologies are going to dominate in the coming era and how they can seize control of those technologies or stop technologies that they can't control. So I'd like to get some discussion going on that.
Yeah, that was a question.
Paul, Tennessee, UDC and New Rules. It seems to me that if I were to place the presentations made today, I would say they're between hard places and rocks. My concern is about jobs and job creation. And in the developing countries, we've had jobless growth for many years. And we've accepted the proliferation of the informal economy. Now it's a reality. Nobody talks about it anymore. It's just accepted. So I wondered if in the United States, the methods that were used during the Great Depression to respond to job creation or to get out with labor-intensive policies and so forth are not applicable in this present crisis. Then what is the way out? And what is the vision of where America would, what America would look like, let's say in 5 or 10 years with respect to job creation?
There was another question, yeah, down here.
Hi, Steve Cleese in the International Education Policy Program at the University of Maryland. Thank you for your wonderful presentations. My question is, I've seen some analysts talk about how the crisis developed over the longer term and was exacerbated by 30 years of what some would call neoliberal educational policies. I mean, this is in keeping with Mark's question and some of the other comments on the market that have emphasized a market fundamentalism and that has criticized strongly the roles of government. I think some of what you say could be interpreted in the light of that critique. The healthcare crisis, the wage bill, the income inequality, and others. But I'd like to hear you talk about it in terms of that crisis, that 30 years of experimental policies, basically. We started in the 1980s with the Reagan administration with a major shift of economic policy. And has that economic policy borne this crisis? And in particular, no one really mentioned deregulation of business and the extent to which deregulation has contributed to this crisis and the extent to which we are not doing anything about it. Thank you.
Uri, why don't we start at this end and then work back from Prakash B.
Well, I'll take the questions on regulations. No, I certainly share the view that a very important contributing factor in the crisis was the loss of teeth of financial regulation. And this is somewhat linked to the point about market fundamentalism, or the spread of the view that the market was the key driver. I'm a trade economist, so I'm a big believer in markets. But I also understand that there are many, many instances of market failures. And, the questions are brought up, two big ones just now. One is on climate change, where, the market is just not going to give you the solution. There are no, the incentives are not there for people to take into account the effect of their actions on the globe, on the global community, etc. So government needs to intervene. And similarly, in financial markets, there are enormous externalities associated particularly with these large institutions and the risks that they take and the impact that they can have on the rest of the system. That is a market failure, and it needs to be corrected. It needs to be controlled. So that's my view. Why did we end up where we are? We ended up where we are in part because of bad ideas, or perhaps good ideas that were taken too far. And we ended up where we were, where we are, in part because of the enormous political weight of some of these institutions. And, we are in a political process. And particularly in the United States, the political system is extraordinarily open to, more open than many others, to the exercise of special interests. This is, it has many positive things, but this is one of the aspects of the system. But it isn't just the United States. The financial regulation and the crisis would have originated simultaneously in a number of other economies, in the UK, for example, in Ireland, are other examples. So political weight, bad ideas or good ideas taken too far are some of the contributors. We need to correct the bad ideas, and we need to be much more aware of the political weight that is carried by these special interests.
Well, as an economist, I would join Uri in my admiration for markets. But I think what's important about markets is that they represent a form of human freedom, not because they're as effective at organizing economic life unaided as economists say. There's a fetish about markets. Markets don't have these properties that economists say they do. I think this crisis proved that. I remember when Larry Summers, who had fairly strong opinions about the economy, not a modest man, came to our executive council in 2009 to explain the steps they were taking and fiscal steps they were taking. He listed 5 things that he never thought he would see in his career, all of which he saw in 2008. He concluded wisely, I think, that anyone who's thinking about the economy today the way they were 5 years ago is almost certainly wrong. But the economics profession has not changed their mind. And I strongly associate myself with the view that this session was not about the causes of the crisis. But I did suggest, and I do believe strongly, It grew out of these imbalances that were developing over a 35-year period, not only the 80s, the mid-70s, and it grew out of a crisis in the mid-70s. It was a fundamental change in policy and on both parties' part in the United States, and it virtually occupied the whole world. It's known outside the United States as neoliberalism. It was the attribution of qualities to markets that markets simply don't have, and it redrew the boundaries for legitimate government action in support of human needs. And it left the market free to allocate goods and people and all the rest within and across borders, and it produced these imbalances. If we had another chance to talk about that, it would be very useful. I'll simply reference that my boss, Rich Trumka, just wrote an article to be published on the crisis of neoliberalism along these very themes. I just want to respond quickly to Tennessee. We are not opposed to getting more extending unemployment insurance. We're not in medical benefits for the unemployed. We want that. We are certainly not opposed to hiring people directly, as was done in the Work Progress Administration and as Paul Krugman recently suggested. In fact, we advocated that from the very beginning. But the key to not just helping people who were unemployed, but to getting, repairing the, as Tom would say, the income-generating process in the American economy is a sustained public investment program to rebuild the foundations of our economy in order to generate the income and wealth that's necessary for us to meet our needs individually and collectively. I think that's the key, and it needs to be substantial in size. The stimulus bill was substantial, but it was not sustained. It's got to be sustained, and if it's sustained, it draws in private investment. You've got $2 trillion on the balance sheets of U.S. companies. They're not investing, they're not hiring. You've got an extra $1 trillion of excess reserves in the central bank. You've got to pull that money off the shelf and put it to work in creating wealth. And the key to that and the kind of mess that we're in right now, it seems to me, rests with public investment.
Well, I think there's sort of two master narratives that are kind of battling here about what happened with the global economy. One is that this free market took shape, whenever it was, the 70s or after the Cold War, and it was just a failure of regulation on the part of the technocrats. The Fed made mistakes. They tolerated a housing bubble. The Basel requirements weren't quite right. And if you fix that, then everything would be fine. There's a more liberal or progressive narrative that says, well, what happened was Milton Friedman, and his acolytes spread market fundamentalism, and then everybody deregulated everywhere around the world. I don't see either of these, frankly. Just if you look at the history. And so I want to give you, since Tom and I started at Yale in international relations, what is the structure of the world economy? We have a hegemonic global system. You have to put the geopolitics back in. The hegemon is the United States. It provides military security, the reserve currency, lender of last resort, and market of, in many cases, first resort functions to the other industrial nations, which were its former military enemies. And the reason it does this is to prevent them from becoming geopolitically independent and remilitarizing. We had this bargain with the other two biggest industrial countries on the face of the earth during the Cold War, with West Germany and with Japan, right? We were the German military and the Japanese military after 1945. We said, make cars. Don't make Zeros, don't make Panzers, make cars. And we will buy your cars. And we will sacrifice our own car industry if necessary, because whenever there was a trade conflict, this went up to the Secretary of State and the Pentagon, and they weighed in, saying we need the Japanese on our side against the Soviets. We need the Germans. We can't destabilize this relationship. Following the end of the Cold War, instead of saying, hey, Europeans, Japanese, maybe you should spend more on defense, and we should stop looking the other way. Because see, here's the other problem with the neoliberal narrative. China is not a neoliberal state. It is a classic 17th century Walpolean British mercantilist state, okay? This idea that if you float the currency, then suddenly all of their other mercantilist policies like labor suppression, excise taxes, state capitalism are just going to go away. the only neoliberal countries, not talking about a few third world countries that have deregulated, sure, the neoliberalism has been influential there. If you look at the leading four countries in the world economy, the United States, China now, Japan, Germany, you basically have three of them whose model, whether they admit it or not, has been to have disguised or overt mercantilist policies, to have permanent trade surpluses with the first, okay? And this is not something that they forced on us. We wanted it because we saw it as a way of avoiding a multipolar geopolitical world. President George W. Bush, in his West Point speech, you may recall in 2003, he says, so we will continue to provide security to the world, I paraphrase, so that other countries, China, Japan, Germany, will pursue the paths of peace. This system worked quite well during the Cold War because the U.S. market was sufficient and the costs of defense were sufficiently low in terms of actual percent of GDP, except in wars like Korea and Vietnam, that this could work. In my opinion, when you invited China, the world's most populous country, to do what Japan and South Korea and Taiwan, and West Germany had done, then the system broke, okay? And so I'm just going to leave you with that question. We just need to put all this stuff on the table because, and this actually answers the question of one of the earlier questions about the Republican Party. How can the Republican Party be a party that is forever in favor of deficit spending? Because that's what it really is. I mean, it's just perpetual deficit spending. It's because we print the world's currency. Right? The reason the French conservatives and the German conservatives and the Japanese, they would love to do this, I'm sure, right? But they can't because their currency is not the world's currency. So, it's just a plea to put the geopolitics back in to the geoeconomics.
Okay, it's difficult to follow that with... But let me just take a couple of the questions. First, I just want to agree with Mark that I'm puzzled too at how quickly the discussion moved from fiscal stimulus to worry about fiscal deficit. It's puzzling to me why that happened and why the people who were in favor of fiscal stimulus didn't fight back more strongly or weren't able to. And it also goes to Paul's question about, I think that's where, that was the time when there was a lot of support for a coordinated global fiscal stimulus. That was the time when ideas of the kind that were tried during the Great Depression could have been tried. I think now it's an uphill political battle to try to push for those kinds of programs. So it really is a puzzle to me why the progressive side of the debate was not able to take more advantage of the opportunities that were granted to them by this huge recession. I mean, the greatest since the Great Depression. Why the progressive side was not able to advance the ball further is a puzzle to me. I want to disagree with Tony, the bookseller, on. He was very articulate, but I disagree completely with this notion of trying to fight for energy independence. I think that's neither practical nor desirable. Ronald Reagan had this slogan, trust but verify, in dealing with the Soviets. I think in dealing with world energy markets, the slogan I want to leave you with is depend but diversify. I think you have to depend on a global market given what it does for you in terms of supplying an enormous variety of energy sources and doing so sort of very flexibly. But you should diversify your sources, both within a fuel type. You should try to import from as many countries as you can. And you should diversify across fuel sources. And I think that's exactly what millions of consumers and producers in the US and elsewhere have been doing over the last 30 years, since the crisis of the 70s. I think if you look at the diversification, we import from many more countries now, over 40 or 50 in the case of fuel than we compared to the 70s. We rely much more on natural gas than we used to, and I think so. I think this energy independence should be off the table as a goal. We really should depend on the global market, but keep diversifying so that we're not dependent on any one source of supply or any one fuel type.
Okay, we're getting very close to the end of our time. I'd like maybe to take 2 or 3 more questions. There's one from John here. I think there were 2 people who had their hands here. Let's make those 2 folks the other 2. We'll take 3 here. John, sorry that the microphone's up here, but it'll get back to those 2 folks at the back.
This has been a very fascinating discussion, and I share the view that the presentations were not only marvelous but short. But I think Michael Lind put his finger on a very important issue, that is the geopolitics, that the U.S. is still dominated in one way or another by the Cold War framework. And I almost sensed a sigh of relief after 9/11 because we now had an enemy again and we knew how to deal with enemies. Where the real issues are the ones he laid out, particularly how you create a new international financial system and a new trading system to replace those that were set up in the Bretton Woods system. And there's an interesting link to what Yuri raised first in his very good presentation, which is the question of the bricks overheating, or some of the bricks overheating, if I remember, because that's been one of the big sources of demand. And I think very little attention is being paid, at least in the United States, to the fact that building up the capacity of the countries to continue to grow, and obviously both to import and export, or export and import, is a terribly important foreign policy question to which the U.S. is paying very little, if and almost no attention to at the moment, whether it's trade and to some extent in financial reform. And the only place I disagree with Michael is that what the countries that have succeeded and grown fast, the 13 countries in the Growth Commission report, did it by not listening to either economists in the United States, or most economists in the United States, or listening to what the bank and the fund and the other multilateral institutions were telling them to do. They did what we did in the 19th and early 20th century to grow and prosper. And this, too, doesn't get into the debate. And I'm glad you raised that issue because it's a terribly important one, Michael.
Yeah, hi. My name is Yuri Borovsky. I'm a recent graduate in international relations from Syracuse, and I'm from Ukraine myself. And I would like first to point out that it's not a Reagan's expression; it's a Russian one. Доверяй, но проверяй. Just literal translation. But here's my question. I'd like to come back to the question of manufacturing, unemployment, and job inequality. And I've read somewhere in a study that in recent decades, U.S. job growth was mostly fueled by the creation of jobs in services, and that's where not the growth in income have been. And then also speaking of which, I would like to point out the U.S. balance of payment structure, and also and ask what are your thoughts on the fact that some goods are tradable, non-tradable, that whole interaction between services, manufacturing, and also what America imports and what America exports, because that's where the jobs are.
My name is Aishan Ibrahim from Georgia State University, here with the National Council on U.S. Arab Relations. And my question goes to the international relations aspect with the emerging markets. One person touched on the fact with the low interest rates, the emerging markets are clearly worried about that. But with the current situation in the global market, the emerging markets have a lot of challenges ahead of us, especially the ones directly working with American companies and the American government. And just with the current global climate, with political and economical, what are the new challenges that the emerging markets are going to be facing, and to make sure that they do grow and help us instead of becoming our new enemies?
Okay.
Well, start in the middle this time.
No,
yeah, exactly.
We're creatures of habit. We'll go start with you, Prakash.
Yeah, I think on the question from the gentleman from Ukraine, I think either Ron or Yuri had a chart showing where the job creation was. Of course, indeed, it's in services mostly, a lot of healthcare. And I think one of them also had a chart showing that the wage growth is kind of polarized. It's either it's coming either in the low wage segment or in the high, and there's kind of the hollowing out of the middle. So I think that's now been noticed and documented pretty thoroughly by David Otter and others at MIT. So I think that's true. I mean, that seems to be the case of this hollowing out as people are describing it now. I think that's it.
Yeah, with respect to the same question, Look, most of the net job creation in the United States in the past decade has been in health, education, and government, and you have services like tourism. And people wring their hands and say, "Oh, this is terrible. We're losing manufacturing, this, that, and the other." You can make a case for manufacturing in a non-flat world because of local spillovers and so on. 50 or 100 years from now, robots are going to make most things. I mean, you're going to have as few people employed in manufacturing as you do in agriculture now. It'll be a few percent. You'll have people in the manufacturing-related, financial and professional services sector, but in the long run, it is entirely healthy for personal services to expand as the costs of housing, energy, assuming that continues, manufactured goods, iPods, gets lower and lower. People want to eat out more. They want better health care. They want more tourist travel. That is perfectly normal and healthy. What is pathological about the American system is not the growth in demand for health care and education. It is bottlenecks in supply caused by the fact that we have medieval craft guilds that write the rules and write the laws, control the supply, by which I mean the doctors and the professors. These are craft production industries that have not been industrialized. If you could break down the functions of higher education and of medicine, and then do them in a way that makes these mass production services that are much cheaper, and the Europeans and Asians have already done it for medicine pretty much. I mean, their doctors are paid less. Their lower level nurses can do more. So I see this as a supply side problem. It's not the demand side, which is perfectly normal. With respect to emerging markets, I would raise the heretical suggestion that there is no such thing. There are no emerging markets. That, in other words, that this concept is a legacy of the neoliberal era where countries, as we used to call them, became markets, right? Where became markets, where education, as we used to call it, became human capital, right? And I just think we need to rethink this framing, particularly with the case of like the BRICS. This went from being an interesting study, by Goldman Sachs, into being sort of like the Axis in World War II, right, or NATO or something. I mean, this is a purely, academic, schematic concept. Sure, you can put Brazil, Russia, India, and China together, but why not just get the leading developing countries? Then it would be, I don't know, China, India, Brazil. I don't know why Russia would be in there. So I would just to be unorthodox, think about these things as countries with their own geopolitical goals, and their own trade policies and their own, instead of having a category of emerging markets, or for that matter, a category of developed countries, where there's some kind of generic developed country with policies and generic emerging market with policies.
Since it's the last comment, I wanted to just say that, I think we have enormous possibilities in this country and at this point in history around the world to change things to more adequately meet human needs individually and collectively, and to deal with fundamental challenges, world poverty, the global warming, and the rest. But our politics have locked down, even in the wake of this crisis. And it's locked down, being argued that the most important crisis we have is a fiscal crisis, not putting people back to work and producing more wealth. And that seems to be catching on. There is a reason for that. Well, I don't want to get into that either. I want to say about this, though. We don't have, in the United States, a short-run budget deficit problem. We're currently selling 10-year paper at less than 3%. Markets are not worried about us not paying our bills. We do have an intermediate-term problem, but that's because of the crisis itself and because of the Bush tax cuts. We ought to get rid of them, all of them. We couldn't afford it then. We can't afford it now. We have a long-run serious budget problem, and that's healthcare costs. But that means getting healthcare expenditure under control. And Michael, I think there is a craft element to it, but that's been around a long time. What's going on now is concentrated economic power of pharmaceutical companies and hospital providers and doctors. That's got to be broken. And medical reform didn't do that. All countries have to have a medium-term plan for dealing with their fiscal problems, as Yuri pointed out. Some countries have an acute, immediate crisis. Think of Greece and Ireland, for example. Maybe Portugal, maybe Spain. But many countries have fiscal space, not just the United States. And for those countries to be sitting on their hands and not using that money to help make this economy move and put people back to work and create the wealth that we need is a terrible, terrible, permanent deadweight loss on the global economy that's depriving us gratuitously from addressing our many needs, both in the United States and globally.
All right, well, I don't know what to say about the fiscal, because my heart is with you, but my brain is not. On the services, I actually agree a lot with what Michael said, and we do have this obsession with things, but actually you can produce too many things, and you know, now in this country we used to be worried about hunger, you know, malthus, etc. In this country and in large parts of Europe now, the big issue is obesity. Okay, and obesity not of rich people, but obesity of relatively poor people. That's one telling example of the fact that you can't have enough of things. Arguably, we are getting to that point on manufacturing. You know, how many cars? How many? Again, I don't want to sound, and it's very easy to sound elitist, but we will get to a point where there are enough cars, and once people have bought their second television set, you know, etc., then the third television set or whatever. And I'm not just talking about the wealthy in this country. I'm talking about a very large part of the population, and so that's why then the natural growth is in services. But I agree with Michael that our services sector, and including in this country, but not just in this country, in Europe, remains an incredibly uncompetitive, in many cases, very, very distorted, very cartelized, very protected sector. And I can't resist pointing out that the professors in economics who have given us free markets are generally tenured.
Well,
yeah. Can I say a word about emerging markets? Because I just wrote a book about it. So, which is I just gave Tom. It wasn't meant to be an advertisement, but I do think that it is meaningful to think of emerging markets as a group, and I do think that they do have some very particular characteristics. Not just the fact that they're going fast, but they have relatively low incomes. They have very different governance structures. They have very different lower capacity to execute on a lot of things. And the reason it's very important to understand that is because on a lot of the issues, including those we have discussed today, making deals with these emerging markets, getting them in the same tent, if you like, on financial regulation, for example, or on climate change issues, is tremendously important. So we have to understand the differences between advanced and emerging markets if we're going to find negotiated solutions, because the differences are there, they are real differences, they're historical differences, and they do condition our ability to strike deals, as we are seeing, for example, at the moment in the Doha negotiations, just to take one example, or the climate change negotiations.
Great. Well, thank you all to the speakers for this fascinating and engaging presentation. We're right at 2 o'clock. I just want to have a couple of last comments. I mean, the question to me was just right, too little, too much? And my first take as I thought about this was to ask myself, what does the future look like? And so I thought the answer might be, and I think we got some of this, I might say too little of the right stuff. We really do face a very deep crisis. I mean, I've been struggling with how, sort of put together some notes on how to close this forum, and I wanted to say something that sort of matches up to the seriousness of the situation that I think we are in. You know, we live in Washington, and that does keep us in this bubble. Most of the people in the room right now are probably doing okay. In fact, I would say that some of us may even be better off than before the crisis. Guess what? House prices in Washington have actually gone up. 401ks and investment portfolios are back up in value. The Federal Reserve and the authorities took care to protect that piece of the system, and very successfully. Now this bubble, and this is the point I think I want to get across here, can terribly distort understanding and mislead us. And it is my convinced view that our Congress lives in a bubble and is distorted by it, and our president and the administration, particularly the people in the administration. The president at least gets out, he gets to Joplin. That's a disaster, but it's a huge, huge bubble in the administration. And if you go out into the country, and I do a little bit of traveling, and my wife is a psychoanalyst, so I hear some stories from her colleagues of people who see treatment now. This recession is absolutely wrecking lives. Working lives are being terminated early. Self-esteem is being destroyed in millions of people. I cannot, say how important that is. It's not an economist's metric, but self-esteem is vital to existence. Families are being destroyed. Retirement assets, I have seen some numbers on this now, are being used up incredibly fast just to survive now. So that means many people will never get to retire and will confront an old age of poverty. So I think there is an enormous human tragedy that is unfolding in our country. And my own view is that, frankly, we have not met the policy challenge. We have not met it because we have really gone along with policy as usual. I mean, I know we've had big policies. It's been bigger stimulus, bigger rate cuts, more quantitative easing, but this is still all in the camp of policy as usual. This recession is different. I think that's what Ron Blackwell said about it. It's a pre-World War II type of event of the scale, really, or getting to the scale of the Great Depression. And that meant policy was never going to work because the system is broken. And that's the piece that has not gotten into the conversation. It's not gotten into the policy conversation. It's not gotten into the political conversation. It's not gotten into the media conversation. We talk of fiscal stimulus, and here's something, this is what I used to say, this is something I've just written a book about this, and this is a metaphor that I use in that book. When Keynesians talk of fiscal stimulus, they call it pump priming. The idea is you fill the gap in demand until the private sector recovers. But stick with that metaphor. Pump priming is only going to work if there's water in the well. And if the well is dry, which it is, that is the problem, then it doesn't work. In that case, you need to drill a new well. And that's the metaphor that I'd like to encourage you to take from here, because that's what I mean by what I say when the system is broken. We need to rebuild the system. We're not doing that. And in my view, what does that mean? That means we do confront a future of stagnation. And I think with that stagnation, of course, comes the human tragedies that I've already talked about, the human level. But I do think there are also some greater dangers that we should fold in, and this kind of brings the political in here. We could, and we do risk a political situation that I call the Weimar scenario. That is when unemployment and economic suffering become so intense that they unleash out of the bottle a political genie of irrationality, intolerance, and hatred. And I think that this should therefore motivate what we do. Yes, you can see how you can come from economics suddenly to human beings and their lives, and then to political tragedy. We have to do a better job at sewing those things together. Well, anyway, thank you very much for coming to this.